Ladies and gentlemen, thank you for standing by. Welcome to Central Garden & Pet's Fiscal 2026 third quarter earnings call. My name is Cleo, and I will be your conference operator for today. At this time, all participants are in a listen-only mode. Following the prepared remarks, we will hold a question-and-answer session, and instructions will be given at that time. If you require assistance at any point during the call, please press star followed by 0 on your touch-tone phone. As a reminder, this conference is being recorded. I would now like to turn the call over to Friederike Edelman, Vice President Investor Relations. Please go ahead.
Good afternoon, everyone, and thank you for joining Central's third quarter fiscal 2026 earnings call. Joining me today are Niko Lahanas, Chief Executive Officer, Brad Smith, Chief Financial Officer, John Hanson, President of Pet Consumer Products, J.D. Walker, President of Garden Consumer Products, as well as Jason Barnes, EVP of Garden Consumer Products. Niko will begin by highlighting today's key takeaways, followed by Brad, who will walk through our financial performance and the acquisition of Trixie in greater detail. After their prepared remarks, John, J.D., and Jason will join us for the Q&A session. Before we get started, I would like to remind everyone that all forward-looking statements made during this call are subject to risk and uncertainty. Description of Central's risk factors can be found in our annual report filed with the SEC. Please note that Central undertakes no obligation to publicly update forward-looking statements to reflect subsequent information, future events, or other developments. You can find our press release and related materials at ir.central.com. Finally, unless otherwise specified, all comparisons discussed during this call are made against the same period in the prior year. Should any question come up after the call or throughout the quarter, please feel free to contact me at ir.central.com. And with that, I'll turn the call over to Niko. Niko, the floor is yours.
Thanks, Friederike, and good afternoon, everyone. I'll begin with our third quarter highlights and then share how we're thinking about the balance of the year. We delivered another solid quarter. Organic sales grew, operating margins expanded, and our teams consistently improved our execution, strengthened our operating model, and enhanced our ability to invest behind the opportunities we believe will create the greatest long-term value. Those efforts are allowing us to deliver stronger financial performance while continuing to invest in the future. One example is Project Horizon, our multi-year effort to modernize our garden logistics network. Since 2022, we've closed 13 facilities in the logistics network. That program is now approximately 95% complete. The vast majority of projects have been delivered on schedule. Every project has been completed under budget, and we've accomplished all of this with minimal disruption to our customers. Since launch, we've shipped more than 1 million small parcel packages through the network, and total shipments moving through those facilities are substantially higher. As utilization continues to increase, we're seeing meaningful improvements in productivity, service levels, and customer responsiveness. Project Horizon reflects the kind of disciplined operational execution that strengthens our competitive position while creating capacity to invest in growth. Across Central, that means investing behind our brands, strengthening our innovation pipeline, expanding our digital and e-commerce capabilities, improving our understanding of cost to serve, and leveraging our strong balance sheet to pursue opportunities that enhance our portfolio. We believe these investments will support sustainable in advancing our Central to Home strategy and significantly expands our presence in Europe. Trixie serves more than 30,000 pet retail stores worldwide with a portfolio that is approximately 90% branded products, a business built on strong customer relationships, differentiated products, and a long history of profitable growth. We expect the transaction to close during the first half of our fiscal 2027. Together, Central and Trixie will create a leading global pet supplies platform with a broader international footprint. Approximately 10% of combined sales generated outside the United States, and an attractive platform from which to participate in the continued growth and consolidation of the European pet specialty market. A profitable, category-leading company with Trixie's scale, brand strength, innovation capabilities, and strong cultural alignment are uncommon. We believe this transaction meaningfully enhances our long-term growth opportunities, and we're excited to welcome the Trixie team to the Central family. That same commitment to innovation continues across our own portfolio. During the quarter, our recent product launches continued to perform well, including Nylabone dog chews made with real meat, Farnham's Endure Gold Fly Killer and Mosquito Control Spray, the Rebel Sun and Shade Extension in momentum, and a continued focus on disciplined execution. While the macroeconomic environment remains dynamic, our diversified portfolio, strong customer relationships, operational flexibility, and disciplined capital allocation position us well to continue delivering profitable growth. Consumers continue to seek value and performance, while e-commerce and in certain categories, private label remain in important areas of growth. These remains an important component of our long-term strategy, and the announcement of Trixie doesn't change that. Even after funding this transaction in the coming months, our balance sheet remains strong and provides us meaningful flexibility to pursue additional high-quality opportunities that enhance our portfolio and create shareholder value. Our approach remains disciplined. We'll continue to focus on acquisitions that fit strategically, meet our financial return objectives, and strengthen our competitive position over the long term. Looking ahead, the exit of our pet distribution business will continue to reduce reported revenue. It will contribute incremental sales and earnings, helping offset a portion of the reported revenue impact while further strengthening our overall business mix. Based on our performance year to date and our outlook for the fourth quarter, we are raising our guidance for fiscal 2026 non-GAAP diluted EPS from $2.70 or better to $2.85 or better. This increase reflects both the progress we've made through the first 9 months of the year and our confidence in our ability to execute during the remainder of fiscal 2026. As always, this guidance excludes the impact of future acquisitions, including Trixie, as well as any future divestitures or restructuring actions and any further tariff refunds. Before I hand it over to Brad, I just want to recognize operating foundation and a culture that continues to embrace innovation, accountability, and customer service. We're entering an exciting new chapter for Central. We have a stronger portfolio, greater financial flexibility, expanding international opportunities, and a clear strategy for creating long-term value. While there's always more work to do, I'm encouraged by the momentum we've built and confident in our ability to continue delivering for our customers, our
more detail, and then I'll provide further comments on our recent Trixie acquisition. Net sales declined 8% to $882 million, driven by the exit of our pet distribution business at the beginning of Q3. In contrast, organic net sales, which exclude the pet distribution, was $318 million, down 4%, with gross margin up 140 basis points to 36%. Non-GAAP SG&A was $182 million, down 6% year over year. As a percentage of net sales, SG&A rose to 20.6% from 20.1%. The lower SG&A spend and higher SG&A rate were primarily the result of exiting the pet distribution business, which carried a lower SG&A rate than the remaining portfolio. Non-GAAP operating income was $136 million, down 2%, with operating margin expanding 90 basis points to 15.4%. higher corporate spend related to the Trixie acquisition, and investments to improve our data below a year ago. And other income was $2 million, slightly above the prior year. Non-GAAP net income was $96 million, down 2%, and non-GAAP diluted EPS came in at $1.54, just shy of the $1.56 we posted last year, from 17.3%. Lastly, our effective tax rate for the quarter was 24.7% versus 25.1%. As a reminder, our tax rate in last year's third quarter was a bit higher than normal due to non-deductible losses incurred in the wind down of our UK business. Now, on to the segments, starting with Pet. Pet segment net sales were $400 million, down 19%, reflecting the exit of our pet distribution business. Organic sales rose 2% to $380 million, driven by broad gains across the majority. Our online sales, a key barometer for the health of our business, were up 10% over prior year, helped by a record Prime Day. In addition, we delivered another quarter of record performance in our professional business, a key growth vertical for the segment and an area where we continue to see significant hide and flea and tick. Segment non-GAAP operating income was $76 million, down 2%, with operating margin improving 300 with continued improvements in margin mix and ongoing productivity benefits in the organic business, offset primarily by higher materials and freight costs. Now, on to Garden. Garden net sales were $482 million, up 3%. Year in both fertilizer and wild bird continue to be at record levels, a testament to the strength of our execution in these categories. Another highlight this year has been our channel partners. Overall, Garden continued to gain market share during the year, with third quarter gains led by fertilizer, wild bird, and grass seed, and remain focused on finishing the year strong. Garden non-GAAP operating income was $91 million, up 7%, with set higher costs, particularly around freight and digital marketing spend. Finally, Garden adjusted EBITDA was $101 million versus $96 million, with margin expanding to 20.9% from 20.4%. Let's shift to cash flows and the balance sheet. This quarter, CapEx was $13 million, and depreciation and amortization was $20 million, both in line with the prior year. We're now planning approximately $50 million of CapEx for the full year, mostly maintenance plus targeted productivity and growth spending in both segments. We bought back a small amount of shares this quarter, about 26,000 shares, leaving $128 million remaining on our current authorizations, making Q3 the 14th consecutive quarter of year-over-year cash improvement. Total debt stood at $1.2 billion, in line with last year, with no drawdowns on our credit facility. Gross leverage was 2.8 times, slightly below a year ago, and below our 3 to 3.5 times target. Net leverage was 0.5 times, an all-time low for the company. It's important to note that these ratios exclude the impact of funding Trixie, as we expect the transaction to close in the first half of fiscal 2027. That said, we do not expect funding of the transaction to have a meaningful impact on our leverage ratios next year. As a reminder, the transaction is structured as an 80% stake for 340 million euros at closing, plus up to 60 million euro in additional earnout consideration. So up to exciting opportunity in pet supplies I've seen during my 9 years at Central. By uniting the premier U.S. and European leaders in pet supplies, we capture a rare and powerful opportunity to expand our access to over 100 million pet-owning households across Europe, a market whose demographic and spending trends around pet ownership closely mirror ours in the U.S. Together, we will be well positioned to consolidate a fragmented Europe. This partnership marks a bright future that we believe will benefit our retail partners, consumers, employees, and shareholders alike. Before we open it up for questions, I want to thank our more than 6,000 employees across Central. Our strong financial performance and improved outlook for the year are a direct result of your dedication and hard work. And with that, operator, please open the line for questions.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment while we pull Brad Thomas with KeyBanc Capital Markets. Please proceed with your question.
Hey, good afternoon, everyone. It's Taylor Zick on for Brad. Thanks for taking our question. Maybe just to start off here on the pet side, the segment kind of has a lot of moving parts with the pet JV, distribution JV. And I think we're lapping some of the exits of lower margin pet durables last year. And then, you have the Champion cattle business, which was acquired in December, though that may, be relatively small. But you noted organic growth about 2% in the quarter, which, it did accelerate slightly from kind of that +1 you had in first half. So I guess, Nico, what do you kind of think the underlying trends are within the pet segment here in the first quarter?
Well, we think there's a real stabilization going on in pet right now. I'll make some overarching comments and I'll turn it over to John to give a little more color. But our pro business was strong. Equine continues to be strong. Believe it or not, small animal, avian small animal had an excellent plants down in South America had burned down, so we had to sort of triage that to get the supply up here. But that was more of a internal issue as opposed to what I would call systemic. But overall, we're encouraged with kind of what we've been saying all along, that we feel like there's got some nice momentum going on in some of our higher margin businesses is what I would say. But John, anything?
No, I think you handled it well and answered it well, Nico. We feel really good about the stabilization we're seeing. Household penetration, buy rate. We got a small animal business, live animal business that is up low single digits, and that's been, I think, the third quarter. It's been stabilized to slightly up, so we feel good about that. Overall, we think we're holding market share, but we're taking market share in key businesses like rawhide, dog treats, flea and tick, and our professional business, and we feel real good where we're at.
Yeah. And I would say, too, that, pretty intentionally, we did the JV businesses that we want to drive. So we're taking a lot of noise out of the business and simplifying what we're doing, and it brings a lot of focus around what's truly important for us.
Yeah, that's great. And then maybe one more, if I can, on the garden side. In time, we've kind of heard others in the industry talk about weather kind of being a drag here in the spring selling season. So just kind of curious on what you all saw during the quarter. And then maybe just kind of how that informs fourth quarter, because I believe we had a pretty strong fourth quarter of the prior year. Curious on how you feel about lapping that and maybe how, retail inventories kind of had ended here.
Yeah, great question. This is Jason. I'll take that question. I'll start with the quarter. We had a bit of a mixed bag in weather. So we started out the quarter with a little bit of cold and wet that translated into a heat dome in the middle of the quarter that then translated into just an extended heat throughout on our brands and our manufactured products. So seeing really good strength within that portfolio, dragged down slightly by our vendor partner distribution business, as we talked about some of the losses within that segment. Looking forward into Q4, we've started out with a lot of the same momentum, seeing really good strength and growth within the brands despite some challenging weather. Brands, so particularly grass seed, fertilizer, and wild bird, where we continue to pick up share in the market. And then your last question on inventories, we feel really good about where we're sitting on retailer inventories. In fact, if you net the impact of our new fertilizer distribution, we're actually negative at retailer inventories in terms of what our inventory position looks like. Just feeling.
We know it wasn't an optimal weather quarter, I should say, and yet it was a record for the garden business. So kudos to the entire team over there for just crushing it in the quarter when, weather was less than perfect. And then I would just call out, I think Jason did call it out, but wild bird and grass seed just absolutely had great quarters.
Yeah, Nico, I think you're spot on there. I think when I talk to the garden team, we say that weather was less than perfect, as you said, particularly in that late April, May timeframe, which is critical for our lawn and garden business. But I think aside from that, the team has managed to produce good results, right?
Yep.
So, kudos to the team.
Can't underscore that enough.
One thing too, Zach, that I would call out just as an umbrella statement related to Q3, that really reflects the health of our business and where we're at. Every single business within garden and pet was up. Very broad.
Yeah.
Very broad.
Yep. And the last thing I would add, just regarding a forward look at the business in the, for Q4 and beyond, this heat dome that Jason talked about, the intense heat that we've seen in a lot of markets across the country during the summer, that bodes well for our grass seed business. That typically means a good.
Thanks.
Thank you. Our next question is from Bob Labick with CJS Securities. Please proceed with your question.
Hi, this is Will on for Bob. Thanks for taking our questions. You all have done a great job reshaping the portfolio recently, higher margins, et cetera. But given the current composition, how should we think about organic growth rates in both pet and garden going forward?
I think, we've talked about this a lot over the year. We're coming out of that trough from post-COVID, sort of that hangover, but we have every intention of getting back to our long-term sort of growth rates. If you think of pet, starting to see that materialize a little bit in the last few quarters. A lot of that is really, internal, because again, we want to get back to a more of a growth mindset. We've been talking a lot about cost and simplicity over the years. And I think this year we started talking a little bit more about growth and innovation and things like that.